Ethical investing, also known as socially responsible investing, SRI, has gained significant traction in recent years. Investors increasingly seek to align their financial goals with their values, supporting companies and funds that promote positive environmental, social, and governance (ESG) outcomes. This comprehensive guide explores the principles of ethical investing, the types of socially responsible investment funds, the benefits and challenges of SRI, and the impact of these investments on both financial performance and societal outcomes. Before starting, don't forget to like and subscribe to our channel for more future updates. Principles of ethical investing. Ethical investing involves choosing investments based on ethical or moral principles in addition to financial considerations. It integrates ESG factors into the investment decision-making process to promote positive social and environmental outcomes. Environmental criteria. Environmental criteria consider how a company performs as a steward of nature. Investors look at factors such as carbon emissions, energy usage, waste management, and environmental conservation efforts. Companies that minimize their ecological footprint and contribute to sustainability are preferred. Social criteria. Social criteria examine how a company manages relationships with employees, suppliers, customers, and communities. This includes labor practices, human rights, consumer protection, and community engagement. Ethical investors seek companies that promote social justice and positive community impact. Types of socially responsible investment funds. There are various types of SRI funds, each with its own approach to integrating ESG factors into the investment process. Exclusionary screening. Exclusionary screening, or negative screening, involves excluding companies or industries that do not meet certain ethical standards. Common exclusions include tobacco, alcohol, gambling, weapons, and fossil fuels. This approach avoids investing in companies that engage in harmful or controversial activities. Positive screening. Positive screening, or best-in-class screening, identifies companies that perform best in their industry on ESG criteria. Instead of excluding entire sectors, this approach selects the top performers within each sector. This encourages companies to improve their ESG practices to attract investment. Thematic investing. Thematic investing focuses on specific ESG themes, such as renewable energy, clean technology, or gender equality. Funds are created around these themes, targeting companies that contribute to positive social and environmental outcomes in the chosen area. Impact investing. Impact investing aims to generate measurable social or environmental impact alongside financial returns. This approach often involves investing in projects or companies that address specific social or environmental challenges, such as affordable housing, education, or clean water. Benefits of ethical investing. Ethical investing offers a range of benefits for both investors and society. Alignment with values. One of the primary benefits of ethical investing is the alignment of investments with personal or institutional values. Investors can support companies and projects that reflect their beliefs and contribute to positive social and environmental change. Risk management. Integrating ESG factors can help identify potential risks that traditional financial analysis might overlook. Companies with poor environmental practices, for example, may face regulatory penalties or reputational damage, which can impact their financial performance. Ethical investing can help mitigate these risks. Long-term performance. There is growing evidence that companies with strong ESG practices tend to perform better over the long term. These companies are often more resilient, innovative, and better positioned to manage future challenges. As a result, ethical investments can offer competitive financial returns. Challenges of ethical investing. Despite its benefits, ethical investing also faces several challenges. Defining ethical standards. One of the main challenges is defining what constitutes ethical or socially responsible behavior. Ethical standards can vary widely among investors, making it difficult to create a one-size-fits-all approach. This diversity of views can lead to inconsistencies in the criteria used to evaluate investments. Data availability and quality. Accurate and reliable ESG data is crucial for effective ethical investing. However, the availability and quality of ESG data can be inconsistent. Companies may not disclose comprehensive ESG information, and third-party ratings can vary significantly. This makes it challenging for investors to make informed decisions. Performance trade-offs. There is a perception that ethical investing may involve trade-offs between financial returns and social impact. While many ethical investments have demonstrated strong performance, some investors remain concerned about potential limitations on their investment choices and returns. Impact of ethical investing on financial performance. The relationship between ethical investing and financial performance has been the subject of extensive research. Studies suggest that incorporating ESG factors can have a positive impact on financial performance. Sustainability and profitability. Companies with strong ESG practices are often better managed and more forward-thinking, leading to improved profitability and sustainability. These companies are typically more innovative, efficient, and resilient, which can enhance their financial performance over the long term. Reduced risk. Ethical investing can help mitigate risks associated with poor ESG practices. Companies with robust environmental practices are less likely to face regulatory fines or environmental liabilities. Similarly, companies with strong governance practices are less prone to scandals and management issues. By reducing these risks, ethical investing can enhance overall portfolio stability. Market demand. There is growing demand for ethical investments, driven by increasing awareness of social and environmental issues. This demand can create positive momentum for companies with strong ESG practices, potentially boosting their stock prices and financial performance. Strategies for implementing ethical investing. Investors can adopt various strategies to implement ethical investing, depending on their goals, values, and risk tolerance. Developing an ethical investment policy. An ethical investment policy outlines the principles and criteria that guide investment decisions. This policy should reflect the investor's values and goals, providing a framework for selecting and managing investments. It can include specific ESG criteria, exclusionary screens, and thematic focuses. Conducting ESG research. Thorough ESG research is essential for identifying suitable investments. This involves analyzing company reports, third-party ESG ratings, and industry benchmarks. Investors can use tools like the Global Reporting Initiative, GRI, and the Sustainability Accounting Standards Board, SASB, to assess companies' ESG performance. Engaging with companies. Active engagement with companies is a key aspect of ethical investing. Investors can influence corporate behavior by engaging in dialogue with company management, voting on shareholder resolutions, and participating in initiatives like the Principles for Responsible Investment, PRI. This engagement can drive improvements in ESG practices and enhance long-term value. Diversification. Diversification is important in any investment strategy, including ethical investing. By diversifying across sectors, geographies, and asset classes, investors can reduce risk and enhance potential returns. Ethical investors can diversify their portfolios while adhering to their ESG criteria. Case studies of ethical investing. Several case studies illustrate the impact and potential of ethical investing. Case study: renewable energy. Investing in renewable energy companies is a popular ethical investment strategy. For example, a renewable energy fund might invest in companies that develop and operate wind, solar, and hydroelectric power plants. These investments contribute to reducing carbon emissions and promoting sustainable energy sources. Many renewable energy companies have demonstrated strong financial performance, driven by growing demand for clean energy and supportive government policies. Case study: gender diversity. Investing in companies that promote gender diversity is another example of ethical investing. A gender diversity fund might focus on companies with strong policies and practices related to gender equality, such as equal pay, parental leave, and female representation in leadership. Research has shown that companies with diverse leadership teams tend to perform better financially, benefiting from a wider range of perspectives and improved decision-making. Case study: Community development impact investing. In community development projects is a form of ethical investing that aims to generate social impact alongside financial returns. For example, an impact investment fund might support affordable housing projects, small business development in underserved communities, or educational initiatives. These investments can drive positive social outcomes, such as improved access to housing, job creation, and enhanced educational opportunities. This is it for today's video. What do you think of our video? Comment below with your thoughts and let us know. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.